Did you know that it's possible to gain exposure to Bitcoin without actually owning it? This can be done through financial tools known as derivatives. But what exactly are crypto derivatives? That's exactly what we're about to explore, along with some common types like futures and perpetual contracts. Stay with us till the end as we break down how they work and what sets them apart using simple explanations and real-world examples. Let's dive in. So, what are crypto derivatives? To understand this, let's first look at the word derivative. It basically means something that comes from something else. In finance, derivatives are instruments that get their value from an underlying asset. In the case of crypto derivatives, that underlying asset is a cryptocurrency. These are essentially financial agreements between two parties who are speculating on the future price of a cryptocurrency. Instead of directly buying the asset, they enter into a contract based on where they think the price will go. For example, consider a futures contract, which is one type of crypto derivative. In this contract, two parties agree in advance on a price at which they will buy or sell a cryptocurrency at a specific point in the future, regardless of what the market price turns out to be. Now, fast forward to when the contract reaches its end date. If the market price has gone above the agreed price, the buyer benefits. On the other hand, if the price falls below the agreed level, the seller gains, because the buyer is still required to purchase at the higher, pre-agreed price. Don't worry if this seems a bit abstract right now. We'll go through clearer examples shortly as we explore different types of crypto derivatives. These include options, swaps, futures, and perpetual contracts. However, in this video, we'll mainly focus on the last two. The main differences between these contracts come down to their specific conditions, which will become clearer as we go along. Let's start with futures. So, what exactly are futures? A futures contract is a formal agreement between two parties to buy or sell an asset at a predetermined price on a set date in the future. Before entering the contract, both parties agree on two key things. First, the price at which the asset will be traded, and second, the expiration date, which is when the contract will be settled. Now, let's understand how crypto futures work with a simple example. Imagine two traders, Mercy and Frank, who enter into a futures contract when Bitcoin is priced at $30,000. Mercy believes the price will rise, so she expects Bitcoin to go above $30,000 by the time the contract expires in 1 month. This means she agrees to buy 1 BTC at $30,000 after 1 month, no matter what the actual price is at that time. Frank, on the other hand, thinks the price will drop. Based on his view, he agrees to sell Bitcoin at $30,000 after 1 month, regardless of the market price at that time. Now, let's look at a couple of possible outcomes. Scenario 1. If Mercy's prediction turns out to be correct and Bitcoin rises to $37,000, she benefits. She gets to buy Bitcoin from Frank at $30,000, while its market value is higher, resulting in a profit of about $7,000, excluding any fees. Scenario 2. If Mercy is wrong and the price falls to $25,000, she still has to buy Bitcoin at $30,000. In this case, she faces a loss of $5,000, while Frank gains the same amount. That's the basic idea behind how futures contracts work, although there are additional details involved in real trading. Now, what about perpetual contracts? Perpetual contracts are quite similar to futures, but with one key difference. They don't have an expiration date. This means traders can keep their positions open for as long as they want. Because of this, perpetual contracts, they are designed to stay closely aligned with the spot market price, meaning they trade at values that are equal or very close to the actual market price of the asset. This alignment is maintained through a mechanism known as a funding fee, which is exchanged between buyers and sellers of the contract. This small payment helps keep the contract price in sync with the real market price. Now, let's take a closer look at how perpetual contracts actually work. Imagine that Mercy decides to trade perpetual contracts this time when Bitcoin is priced at around $30,000. Since she expects the price to rise, she opens a perpetual position at that level. After 2 months, Bitcoin's price increases to around $40,000. At this point, Mercy is satisfied with her $10,000 gain and decides to close her position, locking in the profit. Leverage opportunities, another key feature of crypto derivatives like futures and perpetual contracts, is leverage. This simply means traders can open positions that are larger than the amount of capital they actually have. In Mercy's case, if the exchange offers 2x leverage, her trading power effectively doubles, and so does her potential profit. However, it's important to understand that leverage doesn't just increase gains, it also increases losses. Because of this, there is a significant risk of liquidation. Let's briefly look at how that could happen in Mercy's situation. Before that, we need to understand two important terms: initial margin and maintenance margin. The initial margin is the minimum amount required to open a leverage position. For example, let's assume this amount is $30,000. This means Mercy deposits $30,000 as collateral to open a 2x leverage position. On the other hand, the maintenance margin is the minimum balance she must maintain to keep her position open. If the market moves against her and her balance falls below this level, she may either need to add more funds or risk having her position automatically closed, which is known as liquidation. That being said, perpetual contracts are currently among the most actively traded instruments in the crypto market. At the time of this recording, the 24-hour trading volume for perpetual contracts exceeded $126 billion, compared to around $5 billion for futures. Now, you might be wondering, if the price closely follows the actual market, why not just hold Bitcoin directly? Well, these derivatives serve an important purpose, especially when it comes to risk management. For instance, if Mercy owns Bitcoin and its price starts to fall, she can open a derivatives position that moves in the opposite direction. In an ideal scenario, the profits from a derivative trade can help offset the losses from her actual Bitcoin holdings. Overall, the combination of crypto assets with traditional financial tools represents a significant step forward for the industry. It also gives investors more flexibility, allowing them to participate in the market without necessarily owning the underlying asset. So what about you? Are you planning to explore crypto derivatives, or will you stick with the classic long-term holding strategy? Let us know your thoughts in the comments below. And don't forget to like, subscribe, and follow for more content like this. See you in the next one.